Hello, in this video we'll talk about what adjustments are and why accountants enter adjusting entries into the worksheet. Many of the accounting entries that accountants record are related to transactions that are typically routine purchases from vendors, paying employees for their services, selling merchandise to customers, and billing them for services. But there are some accounting transactions that are not related to those types at all. These non-routine entries come up due to internal operations of the firm during the accounting period. Some of the entries are adjustments for prepaid expenses, depreciation, and supplies inventory. Other adjustments are for accruals and deferrals, which I'll cover in a later video. Rather than immediately record adjusting entries in the general journal and post them to the general ledger, we enter them first into a schedule called the worksheet. The worksheet provides a very convenient way for the accountant to gather all the information in terms of the trial balance, the adjustments, and to determine the effect that it will have on the financial statements. Don't worry if this sounds confusing. We'll take a look at adjustments and the worksheet step by step by reviewing the adjustments we need to make for Eli's Consulting Services on December 31st, 2021. For Eli's Consulting Services, there are only 3 adjustments we need to review for the December 2021 financials. There are many more adjustments accounts record, but for Eli's Consulting, we will only talk about these 3 at this time to explain the concept of month-end adjustments. The first adjustment is related to supplies that were used up in December for $500. We also have prepaid rent, and we need to record the rent expense for December for $4,000. In addition to that, we need to record the depreciation for the equipment that was purchased. What is depreciation? Well, it's the process of taking the cost of purchasing the asset and dividing it up over the expected time that the asset will be used for our business. There's several different ways to calculate depreciation, but we won't cover that right now. For Eli's Consulting Services, we will use the straight line method of depreciation. The straight line method spreads the purchase cost less salvage value in equal portions across the estimated life of the asset. And just in case you're wondering, salvage value is the amount that you expect to sell the asset for at the end of its life. Now let's talk about the estimated useful life. There are also different ways of calculating the useful life, but there are also guidelines that are issued by the IRS. Now let's look at this example. We have a purchase price of $10,000 for, let's say, office equipment. We estimated that we still get $500 at the end of the equipment's life for it, which leaves us with an amount to depreciate of $9,500. We divide the $9,500 by the useful life, which in this example is 5 years, but it could be 7 years, 12 years, or longer for other types of assets. So for our example, we divide $9,500 by 5 to get the amount of depreciation per year of $1,900 or $158.33 per month. The system of recording the depreciation each month is supposed to reflect the decrease in value of assets over time. Is it an exact method? Not necessarily, especially if you think about how quickly a car loses its value in the first year. However, businesses do not want to check the value of their assets every month and then record the loss in value. So depreciation is a good method to reflect the decrease in value of assets that the business owns. One more thing to mention, generally accepted accounting principles require that the original cost of the long-term asset continue to appear in the asset account until the asset is disposed of either via sale or thrown away. That means that the depreciation we record does not reduce the asset account directly. Instead, we'll use a contra asset account called accumulated depreciation. so that we can see both the original purchase price of the asset and the depreciation we've recorded since the purchase. Before we start recording the adjustments in the worksheet, let's look at our worksheet again, and specifically the adjustment column. Just like the trial balance section had a debit column and a credit column, the adjustments section also has a debit column and a credit column. And it is into these columns that we're going to enter our adjustments. The very first transaction is related to supplies. Eli's Consulting began the month with $1,500 in supplies. How do we know that? We can look at the trial balance column, and we can see the supplies account listed with the $1,500 amount in the debit column of the trial balance. At the end of the month, $1,000 worth of supplies are remaining, which means that Eli's Consulting used up $500. We need to transfer $500 out of the supply account to supply expenses. The business could record an entry each time somebody took supplies out of the supply cabinet, but that would not be very efficient. Instead, the business counts at the end of the month how many supplies are remaining in the cabinet, and then figures out how much was used up by subtracting the ending inventory from the beginning balance. So how do we record the usage of the supplies? We do that by writing a credit of $500 into the credit column of the supplies account and a debit into the debit column of the supplies expense account. And with that, we're now ready for the next adjustment. On November 20th, 2021, Eli's Consulting Services paid $8,000 for the December and January rent. We recorded it as a prepaid rent, and we can see the account prepaid rent showing $8,000 in the trial balance column. As of December 31st, Eli's Consulting has used up the rent for December, and we now need to record it as an expense. Why? While the December rent portion is no longer an asset because Eli's Consulting has used the building the entire month. We record the December portion as an expense by transferring $4,000 of the $8,000 to the rent expense account. And we do that by writing $4,000 into the credit column of the prepaid rent account and $4,000 debit into the debit column of the rent expense account. Now we're ready to record the depreciation for Eli's Consulting equipment assets. Eli's Consulting Services purchased equipment in November 2021 for $11,000. The useful life is 5 years, and the salvage value is 0. There are several methods to calculate depreciation, but Eli's Consulting Services uses the straight line method. So to record the depreciation for the month of December, we subtract the salvage value, which in this case is 0, from the cost of the asset, leaving us with $11,000. And then dividing that amount by 60 months, which is 5 years in months. The amount of the monthly depreciation is $183. As I mentioned previously, depreciation is not recorded directly as a reduction to the asset account. Instead, we're now using a new account called Accumulated Depreciation Equipment, which is also called a contra asset account and has a normal credit balance even though it is an asset. An additional term that is often used in connection with assets is the book value. The book value is the net asset value after depreciation, which means that you take the original cost of the equipment and you subtract the accumulated depreciation from it. In our case, it is $11,000 minus 183, which equals 10,817 of a book value. Let's now enter the depreciation into the adjustment column of our worksheet by debiting the depreciation expense equipment account $483 and crediting the accumulated depreciation account for $183. Did you know that some accounts only focus on fixed asset accounts? Fixed asset accountants are responsible for recording the purchase of the business's assets, recording depreciation, tracking the assets, performing asset inventories, and recording disposals. Some businesses have huge teams just for managing fixed assets. As I mentioned at the beginning, accountants record many more adjustments than just the 3 we talked about here. In a later video, we'll cover accruals and deferrals and learn more about those adjustments.